Good afternoon, everybody. This is Bernadette Davis coming to you from and representing JGroup3 International insurance company here in Jacksonville, Florida. Today, I want to take a few minutes to give you a basic illustration on one of the types of products that we use to build wealth. And again, this is one of my specialties here. My objective is, again, those of you who've been following along, we are looking for to build a team here in Jacksonville of agents who are willing to educate, re-educate, and help others create wealth. And today I want to take out a few minutes to share how a particular product will work for that, because I know some people say, well, you know what, I know you're supposed to use life insurance for a death burial policy, or leave a little something for the family, but I didn't know you can build an estate, or didn't know that you can create wealth using a life insurance plan. And yes, you can. So my opportunity today is to help you to see how you can do that by using a basic universal life policy. Now, I'm going to give some generics, and these are not guaranteed values based on a actual person. This is a hypothetical, but it's as close to a real person model as we can get. Again, everybody's situation is unique and different. Insurance rates are calculated based upon your age and in the area that you live in. Basically, whatever state you're coming from, whatever product is being used or sold or service. So today we're going to use a individual here, female, here that abides in the state of Florida. She is 30 years old and she's a non-smoker. Okay, I'm going to give you an actual rate. Now the rate is real, and the figures I'm going to give you are real based on this scenario. Okay, remember, everybody's situation is different. It's based on your individual criteria. Okay, now I'm going to look away from the screen a little bit because I need to go over and get the. Okay, I got what I'm looking for there. Let's move that over. Okay, now this is how this works. All right, you are a female, actually. Insurance agent, yeah. Okay. Let's say you're a single mom and you have you got two kids, and the job you have is relatively decent, but it's not enough that you're going to be able to retire on and have something for retirement. Matter of fact, you're not even certain if there's going to be a retirement available for you on that job. This is why I'm doing this, so it can help you to take control of that unfortunate circumstance situation. Let's say you did not die and your children didn't have to worry about their well-being, and you're still alive, but you don't have a retirement. And unfortunately, the world we live in, a lot of companies are not making retirement plans available to those that are working long hours and spending many years wishing and hoping on a star. And then there are companies that may give you a plan, is nil or next to nothing, or the company might go out of business while you're still working for them, and now you have nothing. Everything's gone. Okay, so you can take advantage of a circumstance, a situation, and take control of it. You do not have to be a victim of unfortunate circumstances based on a business. This is why I do what I do. All right, you can take an everyday life insurance plan and set yourself up. All right, not only are you going to provide protection for your family in case something happens, it's not a matter of if, it's a matter of when your time comes, so that your children can be taken care of just in case they do want to go to college, or you bought a home and you don't want the children to be worried about being misplaced out of their home, or a caretaker if they're still young and there's an executor of a will, which you do need to make sure that you put a will in place. And those are areas where we don't like to talk about at an early age. We think we're here going to last forever. Guys, nobody knows where their time is. It's better to prepare, okay? I'd rather have the information and make preparation than to have my family to deal with an unfortunate, untimely circumstance such as death and not know what to do and how to do. And then if you got small children involved, they're grieving enough. They lost their mom, or even dad, and they don't know what they're going to do. And the last thing that they need to be worrying about is, where are we going to live? Can we stay in the house we live in? What's going to happen to all my friends? Do I need to go to another school? Do I have to leave the state? What's going to happen? Children have real worries and concerns and griefs too. Okay, so you want to try to eliminate that pain as much as possible. It is enough that they're going to deal with the fact that you're no longer there to hold their hands, to stroke their heads, to help them with homework, to just be mom. And now they got to worry about that. Let's just take that. Let's take that equation out of it. Let's take that out of the equation and help that make that day as easy as possible for them. This is why I'm here. Okay, it's real, guys. You know, we don't like to talk about it, but it's real. All right, so let's deal with an average coverage amount of $100,000. Okay, this is a female, and I can give you quotes. Matter of fact, after this, you want to get a quote for yourself, inbox me, tell me, okay, Bernadette, I'd like to have a quote on, you know, a certain amount of insurance. I'll be glad to reach out to you. Make sure I had a point of contact, and I'll reach out to you and give that information to you, okay? In the state of Florida, you may be looking at this anywhere else. It's okay. If you are in another state, just let me know, and we'll get the help that you need, okay? All right, now, so now we're going to be using what we call a guaranteed universal life. Again, these figures are hypothetical figures, but they are based on a real individual, okay? So again, yours is going to be different than what I'm going to quote here because your age may be different and your circumstances may be different, okay? All right, now, let's just say we have an average female and she's 30 years old and she wants to take out a life insurance plan of $100,000. All right. Then we're going to use a guaranteed universal life insurance plan. Now, let me explain. A universal life policy is a little different than whole life. It operates the same, but with the universal, the premiums are usually flexible. With a whole life plan, they're usually fixed. Okay, so we're going to use a plan that you can change the premium on based on your needs or what you want to have accomplished at a certain age. Okay, and also you're going to be able to realize a certain amount of percentage of your money that's going to be accumulating in this policy at that rate. Okay, what that rate is based on the market as well as what's built in the policy. As for today, we're going to use just what's here based on what is just given as a generic, okay? Your circumstance and situation will be built on, if you ask me for a quote today, whatever that quote is going to be based on market rates, okay? Based on your age. All right, now, but for today, this is a non-smoker. She's 30 years old. We're going to take out $100,000 for the death benefit. And she's going to make an additional sacrifice and pay an extra amount of money a month. This is how she's going to build it. She's, instead of taking just the base rate of a policy plan like that, which will probably be $40, $50 a month. So instead of just doing the base, the minimum, she's going to make an investment into her family. She's going to take $250 a month. Okay, she's going to not go to Starbucks for a while. Or she's going to take a side gig, do a side hustle, and make a little extra money on the side, get a passive something going on to help her do this. But she's going to set aside an additional $250 a month out of her budget. Okay, this is a single mom. This is the one that don't have a $200,000 or $300,000 a year income. She may not be making $50,000. She might be just barely making 35 or 40. You can do this. You can do this. If you are making at 35 and above, you really need to do it. The only thing is with you, you need to learn how to cut back on certain your expenses and let's prioritize what's more important. Once you set this in order, then extra can come along. Again, we can always solve the extras, ladies. It's called a side hustle. I do it. So you can keep your budget intact and then don't have to feel guilty spending money over and above what you need to live on. And then saving is now a wonderful objective versus a drudgery. And, you know, oh my God, I'm not going to be able to do it this month. Or I got to live out of my savings account because I got to catch an overdraft or whatever the story is. You can actually have a savings. You can, in other words, you can do this. Okay. All right. Let's assume in the first year she takes the $250 and we are going to give her a guaranteed universal life insurance plan. And let's look at the other things she's going to get here. in this plan, she's going to have a death benefit option where at a certain point, as she's paying additional, this extra $200 a month in this plan versus the base, at a certain point in the plan, the life insurance benefit or the death benefit starts to increase. Instead of being level, it increases. Okay? Coverage amount is increasing. And now let's assume that she only did the $250 from age 30 up until age 70. Right now, that's the common retirement age. All right? Built in this policy is the critical illness plan, a rider. It's a chronic illness rider, a terminal illness rider, which is accelerated death benefit. So accelerated death benefit means if something happens and there was a terminal illness diagnosed, a certain portion of the death benefit can be advanced towards the family, for the family to take care of the medical needs. Okay, that's a good rider. All right, and then now, so let's assume that she is taking this extra $250 a month, and she's making sure every month that she's making her premium on time, making her payment. By year 5, she is 36 years old, and now she's not increased her plan. And as she's not increased her plan, she's still got the base of $3,000 a year, which is a $250 a month. So let's go back to the first year. The first year she does that in the account value, which is the money side of the value of the policy. Let's look at it this way. It's a built-in savings. Let's see it as a built-in savings. Okay. If the first year, and there is no exclusions on the policy, within the first year something happens and she's paid, her premium, and there is no, lapse, or the policy is enforced and something happens, she dies, the family will receive that benefit of $100,000. No questions asked, okay? Now, assuming that she didn't die and she's made her premiums and there is nothing lacking, then the cash value has accumulated to $1,945. Now, there's some such thing as called a surrender charge. So now the first question comes up is, all right, Bernadette, I have this policy that's accumulating cash. What happens if I decide I want to take that money out of there? Well, the first year you're not gonna realize anything more than $60, because the highest amount of cost is in the first year of insurance. So you want to set it and forget it. Okay, you want to set that $250 a month away and forget it. That's why I said do whatever you got to do to make sure you have your extra. If you got to do a little extra on the side, do that. Set this up. Now, it doesn't have to be $250. I said that because you want to be a little aggressive. The older you get, the more time you're going to have to accumulate money, especially if you don't have a 401k plan in place or is uncertain about the 401k plan. Again, we don't know with these companies. You have no idea. Okay, you want to take that into your own hands. All right. So you have this $250 a month, and say, okay, Bernadette, I want to do. I don't have $250. I do $150. You're basically going to do the same thing. The only thing that's going to change is the figures. Okay. All right. So at the end of the first year, the highest cost is the surrender charge. Surrender charge means the cost of taking the money out of the policy. Chances are you're going to lapse the policy, okay? If you're not paying for it or whatever, you take all the cash out, it has nothing in it, and all right, so it's gone. All right, so let's assume that you've been very disciplined. You've been a good girl, you're on top of your game plan. You get side hustle is kicking in that extra $200 a month. Most anybody can find a side hustle with extra $200 a month. And you've been good. You've been very disciplined. All right, now that cash value goes from $1,900 to $3,900. Okay, that's the value in the policy. Is building. Now what's going on is compounded interest. And I won't get into that and get a little bit more complicated, but this is how a universal policy works. This is how you can take a policy like this and build cash values, okay? Now, let's assume that everything's good, now you're making a little bit extra money, you got a raise in your job, your side hustle is really, really kicking in now, and you didn't have any emergencies, and now you have 10 years in. Well, now there's $19,000 in the plan. $19,000 at age 40 is in the plan. Now let's go all the way to age 70. Nope, let's not even go there. Let's look at this. At age 40, let's make an assumption. At age 40, you guys decide you want to buy a house. You know, your dream man or your dream person hasn't come along, and you want to get out of the apartment and you want to buy a house, but you don't have a down payment. Don't you know that you can utilize those values in your policy to purchase your house? Yes, you can. It's called a policy loan, okay? And if you don't use all of it, you won't strip all the cash out of it, the policy can continue to pay for itself after a while. The cash values in the policy builds to the point where that $250 a month, which is $3,000 a year, can automatically be taken out of the policy to keep the policy in force. So after a while, it's not coming out of you're paying for the policy, but then again, you're not, because the cash values now are paying for the policy. But you want to keep going because you don't want to strip the policy. You always want to keep it going, okay? All right. Now let's just say any of that never happened and you say, you know what, I'm in a good place. I already got a house, or we got married, and it's a good guy. He bought the house, and I don't have to really worry about anything. We don't have any major emergencies. Okay, and you're still building your cash, or you guys decided that this plan is going to be strictly for retirement income, supplemental income. Okay, so now we leave this policy in place, same amount of money. And listen, you can always add more to the universal policy. It's only going to go to a certain amount where it won't become what they call an investment type kind of product. You exceed a certain amount of money, but it's assuming that you just want to bump it up a few $100s. You would probably have to adjust the death benefit so that it won't be what they call a taxable event. All right. Remember, death benefits are not taxable. So what you want to do is, all right, well, I need to talk to my agent. Let's see how we can work it out. Or you want to keep it at the same. You want to keep it at the same amount. The $250 is easy. You don't even hardly miss it anymore. Okay. Assuming that you just didn't miss it anymore, you never missed premium, payment is still there. You only went $3,000 a year. Now at age 70, you have $112,000 in this savings account, in this policy. You have $100,000 in your life insurance plan, and your death benefit has increased to $200,000. What'll happen is, should something occurs, the death benefit, if you have not taken the cash out, whatever the cash amount is, you take the cash, whatever the death benefit will be minus the cash. Okay, you will have an extra $100,000 for your retirement to be utilized. You can take that money at that time. If you haven't used it, you can take that money and either get the dream of a lifetime vacation, or help a family member, or take that money and make more. Matter of fact, you would probably do that sooner. Let's assume that all right, let's go in at age, where are you going to come in at 50,000? Okay, at age 50. Now you take, and there's $45,000 in the policy at age 50. You can get a little radical, a little more aggressive, and say, okay, you know what? Let me take $25,000 of that 40 that's in there. You won't strip the policy. It's still money in the policy. You're still making your $250, but now you're going to take 20%, no, $20,000 of the 45 that's in there, and you're going to invest that into either annuity, single premium annuity, or another type of annuity that also increase and give you more retirement supplemental income. This is what I'm talking about, creating wealth. You start with one simple little plan, some discipline, and a great goal, and you watch it and you work with it and you work with it, and you set a goal and you say, okay, this is what we're going to do. And so now you take that same money that's providing a death protection or death benefit protection for your family in the case of your untimely death, and you are building from there. So it's almost like taking, oh gosh, how can I say this? You're building a house on rock instead of sand, okay? And you get the house where it's set in order, and now the house has value. All right, this is good. Now at 10, 15 years in the house, now the house has value. Now you can take that money, and instead of splurging, you take some of that money at that house and go buy gold. what have you done? You have increased your asset base, and you have increased your net worth, and you have created a legacy. You have created wealth. You are literally taking money that you use, starting from one simple little seed, and you are multiplying that seed. And now you're talking about diversity. You don't need a stockbroker to do this. You can do this on your own. Now, you can have 2 or 3 different types of supplemental incomes being set up out of one source, and that started off with a life insurance plan called the Universal. Okay? Simple, easy. Listen, that excites me because I know it works. I know it works. So what you want to do is you want to reach out to me. You want to say, okay, Bernadette, I would love to get something like this going. I don't have 250. What can we do with $75 a month? It doesn't matter if that's all you have to start with. That's all we have to start with. As long as you use some discipline, you got a goal, got a plan, it'll work. Because at some point in time, you will have more than $75 a month. You can make it happen for yourself, okay? Reach out to me at Bernadette Davis Life Insurance Agent on Facebook, and I'll be more than happy to reach out to you and give you all the information you need on how to set this up, establish yourself in wealth, take control of your finances, create a legacy, create an estate for your family, make sure that all is well as much as you can. And who knows, you may outlive. If you live out to 100 years old in this plan, oh my God, people are living longer. Let's say you did live out to 100 years old. Now you got $200,000 worth of life insurance in that plan. I mean, cash is in there, and who knows? At 100, I mean, there are some people that are very lively in their late 90s, okay? Or you just decide you want to leave that to your family or your children for them to establish wealth for themselves or to start a business or whatever else they might need to do, okay? Wonderful talking with you today. I hope you have a great and wonderful afternoon. Remember, reach out to me, ask me any question, comment me, say, okay, Bernadette, I want more information. What do I need to do to get started? I'll be glad to reach out to you. Have a wonderful day. Thank you so very much. Bye-bye.